So we're here to talk about wealth today. Once we've bought businesses, we've built them and we've sold them, what do you do with the wealth that you can create off the back of it? So interesting to share some of the things that we've learned along the way, and I guess how you can plough some of that back into either future deals or what you can do to create that sort of passive income.
Yep. I think Paul is obviously the most experienced here with the, not grey hair, but definitely a bit more of the experience on the selling side of things. So I think to begin with, bought more than 96 companies, 97 right now. I guess, could you give us a rough idea as to how many you've managed to sell so far over the last 13 years on that front?
Yeah, to be honest, probably lost count. So, our model is to buy, build, sell. So, at the moment, I think we're invested in around 29 different companies. Yep. So we've got quite a lot of different interests, so different ends of the spectrum. We've got businesses that we've only just bought that was on the beginning of the journey, and some that are more mature where maybe we're actually pursuing some sort of exit strategy. So our model is 3 to 5 years, buy, build, sell. Yep. So generally speaking, when we're involved in a business, it tends to be more the medium term. So we go through a 3 to 5 year plan, and we look to exit. Yep. Typically we buy a long established family run business. Yep. We go in, we improve it, we give it tools, the resources, and the capital to help it expand and grow, and then we'll look to exit from that and create that capital event.
Yep. And there's obviously, when you go out and sell, there needs to be a market for selling, right? So there needs to be a buyer's market. So we've probably talked on other podcasts about like manage and buyout, so like having the management team buy you out, maybe having competitors, maybe having other investment firms that are looking at buying into the sector. What's been your most prolific way of selling businesses over the past couple of years in your experience? What's been the easiest way to sell the business once you've bought it?
I would say, to be honest, doing it yourself. There are obviously brokers out there that you can engage, or corporate financiers that will guide you through a process. They'll go and do the marketing, they'll go and find the buyer. But my experience of working with them is that they have their own agenda. They obviously charge high fees, and to justify those high fees, they've got to do something for that. And that's why you tend to find that a lot of businesses that tend to be listed for sale are overpriced, they don't sell. I've read a stat somewhere that I think 1 in 5 businesses that are listed with a broker sell. Yep. What about the other 4? Yep. So what we do, we again, it's a process. So the first thing we'll do is get our house in order. So that's making sure the accounts are up to date, making sure the business is presented in the best way. Obviously, we know we're going to go through a due diligence exercise, so we actually get that already. So we populate a data room that can be reviewed by serious buyers once they've signed an NDA and whatever, and expressed an interest. But we then get a long list of who's going to buy this business. That could be the staff, management team, it could be a competitor, trade buyer. If it's big enough, it could potentially be on the radar of private equity. So there's a number of different routes that you can go, but we basically write a long list of all the people that potentially could be interested. It could be your customers, it could be your staff, it could be your suppliers, it could be a competitor, etc. And then we think about how do we connect with those people. So we'll sort of put a 1 to 2 pager together which summarises the opportunity, some headline financials, and then we'll present that to them. Now either you can do that directly, but sometimes maybe a business owner might feel a little bit uncomfortable doing that because you don't necessarily want to know, you don't want your customers and staff to know that you might be selling the business. So you might pay a corporate advisor to just do the marketing piece for you and almost act as that middleman to have those initial conversations and get NDAs in place and that sort of stuff. But I would say that the biggest thing to drive the best value, and it's not necessarily always about selling for the highest price, is to get 2 horses in the race. So always have at least 2 options. I mean, it's a bit like if you're buying real estate and you go to an auction, you've got all the buyers in the room and they're all bidding, and it goes to the highest bidder. And I wouldn't say that that's always the driver. Sometimes it's more important that the buyer is going to be a better home for the business, is going to look after the staff, all of those sorts of things. But you've definitely got to have more than 1 horse in the race, because if you haven't, and that buyer wants to renegotiate or chip the price, or they might pull out because they change their mind or whatever, you've always got to have that plan B.
Yeah. And what would you say so we mentioned before that when you're trying to sell a product, right, you want to mitigate as many efficiencies as possible out of that selling side of things. How would you say that can be done when you're looking to sell the business, right? Can you arrange the financing for them? So can you already arrange the asset-based lending financing for the new buyer so that they just sign the paper? Can you look at other financing structures where you bring in, a financial institution on board for the acquisition? Is that something that you've tend to looked at in the past? I know we've obviously done, but I'm trying to get you to investigate a bit.
Yeah, absolutely. So I mean, it's one of the things that we'll always consider. If we were going to sell this business and we were the buyer, for example, what would we do? How would we do it? And one of the fundamental things is obviously having the cash to be able to do it. Now, if you're a competitor that's making more profit than us, then potentially you've got the ability to raise capital to buy the business. But if it's a management team that maybe it's like a management buyout, then whilst they might well invest their own cash in it, probably in the grand scheme of things, they're not going to be able to get their hands on the cash. So there's been several businesses that we've sold over the years where we've actually gone and found funding for a management team to able, to facilitate a buyout. So yeah, absolutely will be something that we'll be looking at when we're exploring an exit.
Yep. And in regards to, some past examples around a business that you've bought, say in January 2020, okay? This is just an example. How quickly have you seen buyers align with, the purchase price or the expectations that you had and the closing timeline in that regard? What's been the quickest sale that you've managed to do over the last 13 years?
Yeah. So this is unusual,
Yep.
but we have done a deal within 4 weeks of signing heads of terms to actually exiting from a business.
4 weeks.
But I would be honest and say that is very unusual. Typically what you tend to find is the process takes, if you're really lucky, maybe 4 months, but more realistically, it can be 6 to 9 months. So I guess, look, we buy businesses, so we're used to the process, we go through it, and it's just a process at the end of the day. We can typically complete a deal within 3 or 4 months. But I guess when we're selling and we're on the other side of the table, we're sort of almost at the mercy of the buyer and how quick they're going to go through the process and how experienced they are and whether they've got their advisors engaged and all those things that can take time.
Yeah.
But I guess it's also an educational piece that we will always set expectations at the outset with a buyer that, this is our expectations, here's the data room, it's ready for you to review. We've already engaged our advisors, they're ready to go, and then we try and manage them through that process really so that it does happen relatively quickly.
If you were to be someone that's just starting out let's say we put, I like this example because you start without resources, okay? We put Paul in the middle of London or in the middle of, Cyprus, Greece or whatever, and you need to make 7 figures within the first, say, 12 months, okay? So you need that money at the end of the year. What exit structure, what acquisition plus exit structure would you try and use in order to make that happen in like a 12-month period?
If I was absolutely broke and had absolutely nothing and needed to create 7 figures, I would probably look at like a virtual merger.
Okay.
So I've actually gone through this process a couple of times. One of the industries I was involved in my earlier career was in the real estate industry. So we went around and we convinced real estate businesses to join together to form a larger group, and the reasons that they would do that would be they can drive synergies, cross-selling opportunities, buying power, etc. But more importantly, from an investor's point of view, that becomes more investable, because if you've got 10 real estate companies and let's say next year 2 of them have a bad year, profits dive, someone leaves, whatever, you've still got 8 other businesses that are making money, so it basically hedges your risk. And that's why I guess larger companies typically sell for larger multiples and more money, because they present less of a risk to a buyer. So yeah, we went around speaking to real estate businesses, we pulled them all together and we basically did a virtual merger. So they all sign a contract to say, if you get me a valuation of X, we agree to tag along in a sale, and you can charge a percentage of that or take an equity stake in the holding company. So that would be if I had absolutely nothing. Sounds easier said than done, and it is a bit of a complicated one. It's a bit like herding cats, but that's probably where I would go if I wanted to try and create 7-figure sum within a year.
And say you were to have, I know the answer to this, but for the audience is building up, okay? Say you were to have 51% of a business and I were to have 49% of it, right? So in principle, you've got more of an ownership / decision-making power over me, right? As the majority shareholder. But I wanted to sell my business. I wanted to create liquidity out of, my shares, right? what kind of clauses can you put inside a business on the exit front in order to facilitate liquidity events, right? So exit events for minority shareholders or majority shareholders, so that everyone is aligned on the exit front. What kind of things that can be?
Yeah, so we're very honest and upfront with people when we joint venture with them. So if somebody's going to work with us and we're going to build a group and then we're going to sell that group, then we're pretty transparent about it's going to be a 3 to 5 year plan. So everybody's expectations are set. So you can't end up sort of getting there and then them turning around saying, well, I don't want to sell yet, or I wanted to sell sooner, because everybody was told about the plan in the first place. But we do build into the shareholders agreements drag and tag clauses. So effectively, whether you own 10% or 90% or 50% or 51% or whatever your percentage is, there's a drag and tag clause, and this works both ways. So it effectively says, if I find a buyer for my shares or the overall business, you agree to either buy me out within 30 days and match the offer, or if you fail to do so, you agree to tag along with the sale, and that works vice versa. And the reason that we do that is it means that, you know, as long as everybody's expectations are set at the beginning and they know that we're going to be on a 3 or a 5 year plan and that we're going to get to it, it means that we don't end up being in a business for many, many years, more than we actually want to be in a particular industry, because we've delivered the plan. And not that it's ever happened, but in the event that the other party didn't want to sell, well, they've got the option to either buy us out and carry on, or they have to tag along, and it means that we can get out of the business.
Yep. I think that's one of the key myths to uncover, right? Around like the 51, 49, 50 plus pint.
You can control a company with a very, very small percentage. I mean, it does differ from sort of jurisdiction to jurisdiction, but you know, you could have a 90% shareholder and you could only own 10%. But if you get the shareholders agreement right, you can pretty much control the business and what happens.
Yep. And what are the actual mechanics of selling the business? Okay, so you've signed the share and purchase agreement. You've got some kind of account somewhere. How does the lawyer navigate, expectations on closing date? When you receive the money, when do you have to pay tax on that money that you've received? Can you run me through exactly the date? I guess the first 30 days or the first 60 days?
Yeah, so completion day is actually a little bit of an anticlimax. It's almost like, if you ever bought a house for the first time, you get the keys, you're dead excited, you pick them up for the estate agent, you get to the house, and then you've bought a house for the first time. Buying a business can be actually more of an anticlimax, because actually there's none of that sort of excitement on the day, because generally what tends to happen is you just get a phone call from the lawyer maybe mid-morning just to say, right, all the funds are transferred, it's done. Everybody's signed electronically, everything's been lined up, and then obviously the hard work starts in terms of you've got to go in, you've got to speak to the staff, you've got to get everybody on side and all of that sort of piece. But actually it's a very, very simple process. Funds are generally transferred within a few days, if not the same day. And then in terms of tax, it really depends on your jurisdiction and all of that. But if you look at the UK, for example, as a business owner, if you sell a business, you're going to be liable to capital gains tax. So if you benefit from business asset disposal relief, which used to be called entrepreneurs relief, at the moment in time of us recording this podcast, you'd pay 10% on the first million, and then 20% anything over and above that. And if you structure the deal in the right way, let's say you don't get all of the cash up front, and let's say you've got some sort of deferred note or earn-out structure, then if it's structured in the right way, you will pay the capital gains tax when you receive the money. So you don't have to pay all of the tax up front on the overall purchase price, you just pay the tax as and when you receive the money yourself. So it sort of reduces the burden a little bit.
So let's say you sell a business for 6 figures, okay? So like you've got 100k plus, you don't get to 500,000, okay? Let's say you've got 100k plus. What will you do with that capital if you knew what you know now with 100 grand? What would you do with that? As opposed to going into the likes of private wealth banking, which is like a whole nother beast all by itself. What would you do if you couldn't access something like private wealth banking with 100 grand?
So I think for me, I do what I do because it's fun. Yep. I love doing deals, I love M&A and all of that, and wealth, I guess, off the back of it is a byproduct. So whether it's your first 100 grand that you make from your first ever deal, or whether it's your 100 millionth amount that you've received, what I tend to do is invest what I make back into income producing assets. So with 100 grand, you could buy a few buy-to-let properties, you could rent them out. The rent is then passive income, covers the mortgage or whatever you're doing, and you can create it's almost like a snowball effect.
Yep.
And wealth banking is very similar. It's just done on a bigger scale with
Yep.
more creative products than.
So what is private wealth banking then, for the people that don't really know about that? What is it exactly?
Yeah, so for me, I remember when I got onto the private wealth banking ladder, and it was it was almost like this penny dropped of this is how the rich get richer. So the way that wealth banking works is you invest some money and that you trust the bank to go and invest that money for you. I don't profess to be an expert on all the wonderful derivative products that they might decide to sell to you and put your money into, but that's what you're paying them for. They're the experts. They've done the research. They understand which markets we need to be in, the products that we need to be in, and obviously it's then based on your level of risk. You've got low risk to really high risk and your appetite for all of that. But the idea is to try and create a diversified portfolio so that you're not all in equities or you're not all in stocks, in bonds. You've got this widespread, diverse portfolio. But the great thing about wealth banking is that there's this thing called Lombard lending. So you can, very similar to how a mortgage works, you can leverage against your portfolio. So when you buy a house, let's say you buy it for cash, you could secure a mortgage against it to take the cash back out. Lombard lending works very similar with your portfolio. So let's say you've got stocks, shares, bonds, commodities, crypto, whatever. The bank will lend a percentage of your portfolio back out. They'll even lend against your own cash. So let's say you've got $1 million in the bank, and they'll lend you pretty much all of that back. So effectively, the idea is that you keep the $1 million of cash and you invest that in whatever their products are to create that passive income, and you then take the $1 million to go and do whatever it is you want to do with it, buy a property, I don't know, buy a boat, whatever you're going to spend your money on. But the idea is that you sort of become self-funding. So if you've got 10 million in the bank, you borrow against that, you invest that borrowing, and you turn that 10 million into 20 million over a 3 to 5 year period, depending on your appetite for risk. So really interesting. And of course, lending with Lombard is a lot less than you go to your commercial bank and take
What's
out
the
personal
cost
loan.
of? So thanks for tuning into the Buy, Build, Sell podcast. Please visit buybuildsell.net in order to access our free community on buying and selling and building businesses, so that you can access like-minded entrepreneurs, get access to free resources, and be able to access content that is not available online that will help you on the deal-making journey. We promise not to spam you, and we will be sending you the next episode on your email for free at your disclosure. Thanks a lot. Like getting a loan out with like Lombard lending right now?
So it really depends on the currency that you're going to do it in. Okay. So at the moment, US dollar is typically the best, and most investments tend to be made in US dollars. Euros aren't as attractive. Neither is sterling. But you're probably looking somewhere between 3 and 5% if you're a European-based client. Okay. Whereas if you look at the UK, interest rates are close to 5%, so it's actually pretty decent.
Yep. I think one of the key things that is talked about is like cash is king, but it actually isn't. Liquidity is king, because liquidity solves a lot of the problems that cash does, right? Well, essentially all of them. So if you can access liquidity, which is what the Lombard loan actually enables you to do, right, that can solve a lot of the problems.
Yeah, I mean, keeping cash in a bank is actually a liability.
Yep.
The banks will charge you money to hold cash, so it's better to put that cash to work, invest it in investment products, take the cash out as a Lombard and go and invest it in something like buy real estate, for example, and rent it out, or whatever you're going to do with it. So yeah, I mean, obviously, everybody has their living expenses and you need to probably have a bit of a cushion, but yeah, keeping large sums of cash in the bank, we're all sort of trained when we go into school and education that, you need to get a job, you need to earn some money, you need to save, you need to get a pension, you need to keep as much cash as you can in the bank. Actually, you shouldn't be doing any of those things. You should be trying to make as much cash as possible, but then looking to reinvest that into income producing assets.
Yeah. In fact, having cash in the bank within like a European bank, essentially, it's not insured, right? So like if you go above and beyond a certain level, I think in Spain it's like 86 grand. It's not really insured, so you could actually lose that money that the bank is holding off you, right? So yeah, really interesting. And then what about tax-wise? I know you've moved over to Greece, right? You were living in the UK. What's been your experience in creating like international tax structures? Have you used advisors for that? Would you recommend using advisors? What's your experience on that front?
Yeah, so probably just to give a bit of context, I think that tax is tax at the end of the day, and it's just that there are some countries in the world where you pay a lot higher tax than other countries. So, for example, if you're an American and you're from the US, you could go and move anywhere around the world that you wish, but America is one of only 2 countries that will tax you regardless of where you live. So if you're an American citizen and you go and live in a country in Europe with a lower tax, you will still have to pay the US government. There are a few things around, you can earn a certain amount before tax kicks in and stuff, but basically they'll tax you on your worldwide income regardless of where you live. There are other countries that perhaps aren't as tax friendly. So I was born and bred in England, the United Kingdom, the UK pretty much, if you're a high earner, you'll be probably paying at least 50% of your earnings in tax. There are other places in the world where you can live and pretty much, if you structure it right, not pay any. So you can go move to Dubai and pay 0 tax. There are other countries like Singapore, like Cyprus, where tax is a lot lower, and you can live so effectively for the money you would have earned in the UK. If you go and live in Singapore or Dubai, you'll end up with more. You won't be paying as much in tax. So tax is a very complex area, and everybody's individual, and it depends where you're from and where you're resident and what citizenships you've got and stuff. But yeah, I don't have any problem in paying tax, but I would rather live in a tax-friendly country where effectively more of the income that you're earning you can deploy into investments to create more.
Yeah. And then in regards to going back to wealth, private wealth banking and so on, what kind of returns are you getting right now on, say, the investments that you've currently got, so that we can kind of compare the options that you can get through private wealth banking and maybe the typical buy-to-let real estate portfolio that's generating you 12% on a yearly basis? What kind of difference?
Yeah, so when I was growing up in the UK, my first job was in the real estate sector, and I thought that the holy grail of creating some wealth would be to make some money and invest it in property, rent it out, and sort of almost live off the rent. But the thing with the real estate market, particularly in the UK, and it's not dissimilar to other Western jurisdictions, is it's highly regulated. The returns now are pretty dim. In the UK, you'd be lucky if you were getting sort of 3 to 4% return, which is really quite poor. So you can go and look at wealth banking as an alternative in terms of creating those sort of those income-producing assets. So it depends on your level of risk. I do know some people that get 70% returns, but they're taking very high risks. My tolerance perhaps isn't so much with that. But to give you some examples, there are dividend paying stocks that pay dividends every month. So you could stick $50,000 into a dividend paying stock and probably get a 10% return if you pay the bank to go and find you the right ones that pay monthly and regularly and have got a track record and stuff. You can invest in bonds and get 8 to 12% coupon. So you could put 100 grand in and get 8 grand, and if you do that so many times, then you've got that recurring income. There's then more volatile investments like equities or commodities, but it's about trying to have that like diverse portfolio. So typically at the moment I'm probably looking at somewhere between 25-27%, which is not bad in the current economic climate. If I was more willing to take a bigger risk, then maybe I could chase those 60-70% returns, and equally if I wanted to lower my risk level, I could just invest it in bonds and earn the coupon and maybe make 5 to 8%, but without any hassle or stress.
And when you put, like, say, 100 grand into a bond or into a stock or whatever, I know that they can give you like a loan to value, right? Normally the typical acquisition of a real estate portfolio, you can buy 70% of it on loan or like a mortgage and 30% on the equity side of things. How does that tend to look like on the bond side of things? So
Yeah, so typically the wealth bank will only ever invest in, really good rated investments. So, you wouldn't find like low rated junk bonds, for example. You're more likely to find, A-graded, credit rated bonds with big blue chip companies like Apple or Tesco or people like that. So they represent a very low risk from a bank point of view. So typically, you will lend somewhere between 60 and 80% in a Lombard loan against those sorts of assets. There are some equities where you can get sort of 85%. Cash typically tends to be about 95%, depending on which currency that you're in. Commodities, again, tend to be around about sort of 70, 80%. So, if you've got $1 million in commodities, you could probably borrow 700 grand against it. If you've got $1 million in high-graded bonds, you could probably get 800 thousand as a Lombard, which you can then either take out to go and invest in something else outside of the bank, or I guess the smarter people tend to invest some of that, not all of it, but some of that back in. So I could invest $1 million, take out 300 grand Lombard, and choose to buy more bonds, and as long as the coupon versus the charges versus the return all stacks up, then effectively you can turn that 300 that you've borrowed into more money, aside from the $1 million that you may have invested in the first place. Yeah.
It's kind of like when you talk about compound interest, that's literally very easy to do once you've got, I guess the first $1 million, $500,000, which is, I guess, the threshold that you get asked when you join private wealth banking. Any other inputs that you would say for someone that's looking to, say, get the first 1, 2, 3 million in regards to wealth generation, so like at the exit, but then what to do with that? Any other inputs that you would?
Yeah, everybody's got to start somewhere. So I think, look, if you're listening to this and you're inspired to get into the world of M&A, or you're doing something in a business that you want to create that wealth, then, have that focus, find a mentor, a coach, someone that's been there, done it, worn the t-shirt, that you can share the experience with and learn from, and avoid maybe some of the pitfalls. And then it's similar, like when I first ever got into wealth banking, as it was completely new to me, I went and spoke to a load of high net worth people that I knew and asked them about it and got their take on it, and even got some introductions into some of the banks that maybe have more creative solutions. Yeah. So, go out there, talk to people, learn about it. You don't need to become an expert, but it's it's a bit like using the analogy of if you're going to get into M&A, you don't need to be an accountant, but you do need to understand what a balance sheet and a P&L is, and I guess you need to have a basic understanding of how the whole sort of wealth banking piece works.
Yeah. Now let's touch on the last bit. So like I've seen articles on Jeff Bezos taking a loan against his own asset, which is Amazon, let's call it, and getting paid that way, right? So a way of essentially not, if you look at the salary that Jeff Bezos pays himself, or Elon Musk or whatever, it definitely doesn't pay for that large boat or that large yacht that they just bought, right? So how do they, if you've got a good asset base and you've got a good business to lend money against, how does that tend to work in terms of how you pay yourself, maybe in the form of a debt that you over time pay off? How does that tend to work?
It's very similar to sort of Lombard lending. So, there are some, mega famous entrepreneurs around the world that, get slated in the media because they don't pay any tax. But the reason is that a lot of their wealth is tied up in their business. And, let's say you're the owner of Amazon and you've got Amazon stock. Well, you could put that Amazon stock into a wealth bank and you could Lombard against it. So I guess from all intents and purposes, on paper, you might not pay yourself anything from that company because all of your wealth is tied up in the shares, but you can loan against it. You can take that loan out as cash and use that to pay for your living expenses or buy your boat or whatever it is you're going to spend your money on. But you can, effectively that's how, these people don't pay a great deal of tax. And some people, there's moral arguments for and against all of that sort of stuff, but if you look at some of these big organisations, think about how many employees around the world that they employ, how much tax those employees pay, how much VAT and sales tax they collect, how much corporate tax that organisation might pay. So I guess there's a balance between it and stuff. But
yeah. So yeah, I think that's that covers pretty much most of Paul Seabridge's knowledge around what he's learned around the the last exits and how to manage that capital once you've got it, right? Which is almost as difficult or even more important than actually creating it, keeping it at the end of the day.
Somebody once said to me that it's dead easy to make $1 million, but it's even easier to lose it. It's the same when you make 10 million, it's dead easy to do one bad deal and end up losing it. So I guess it's like everything, it's surround yourself with experts that understand about managing wealth, whether it be the banker that you're going to employ to manage your wealth for you, but make sure that you're surrounding yourself with experts and you avoid those pitfalls.
Yeah, perfect.
Cool, thank you for listening.
Thank you guys.
Thank you for tuning into our podcast today. Have you tried our free survey to assess your skills as a deal maker? Visit www.buybuildsell.net/survey to take our free survey and assess your skills as a deal maker.